Hello, everyone. In this lesson, we'll be talking about fair value gaps. The fair value gap is a three candlestick pattern used primarily in the market context, and order flow analysis. It identifies area on the chart where price has moved rapidly and there was inefficient or lack of liquidity. We can think of it as a price gap or an imbalance between supply and demand. I have this picture uploaded here. This is a simple bullish fair value gap. So it's a three candle pattern where the high of the first candle this down for this now. This is a bullish fair value gap. So you see this three candle pattern, first candle, second candle, and third candle. And the price has a high momentum around there, leaving a gap instead of having it this high now going to overlap with this low. This is the first candle, this is the second candle, this is the third candle. If price moves rapidly across this area, there is not any efficient liquidity inside. So you see at the high of this candle, which is this, it didn't overlap with the low. And then for bearish fair value gap, you see this is the low of the first candle. It's not overlapping with the high of the third candle. Now, in key points, I try to write down this, but I think I'm going to have this put this as a PDF in the description section. We call concept imbalance and inefficiency. In an inefficiency, what it is, the fair value gap occurs when buying or selling pressure is extremely one-sided. This causes price to gap through a price range without transaction occurring there. The market dislikes inefficiency and on-off-year gaps. This area therefore acts as magnets. Now, the price is highly likely to return to this zone to fill the gap and collect leftover liquidity. This is a simple way to identify it, which I already explained. You see, if a fair value gap is identified, is defined as three consecutive candles. There are two types: bullish fair value gap and bearish, which is what we have here. I have a bullish fair value gap and a bearish fair value gap. So it's important to look for a large upward moving candle flanked by two candles that have no overlap in their wicks. The low of the third candle is higher than the high of the first candle, which is what I just explained here. The low of the third candle, there's the low of the third candle. It not overlap with the high of the first candle. Okay. Now, the gap, the interpretation, extreme buying pressure, the fair value gap zone becomes potential future support area. For the bearish fair value gap, the sell-side imbalance is the vice versa of the bullish fair value gap. The bearish fair value gap, you see the low of the first candle did not overlap with the high of this candle, and there is a high momentum of selling pressure that causes price not to fill this area here. We find that market finally generally returns. Not all fair value gap gets filled. Actually, not all fair value gaps get filled. You'll see that imbalance that happens in buying or selling. You see the price returns there at a future time. How traders use fair value gaps. Fair value gaps are not standalone signals, but they are used for great context and confluence as support or resistance. So rather than here, that's resistance is supposed to stand for resistance. This is the primary use. Once price creates an fair value gap and moves away, the gap zone becomes a key level. Traders will look for price to return to this key zone and then show reversal signal, e.g. a bullish candlestick pattern in a bullish fair value gap to enter a trade in the direction of the original trend. As the price goes and returns back, let's say we have one here. This is on the 4-hour time frame now. You see, there is a fair value gap that formed during the Asian section. You see the price lifts this fair value gap, trades a price range, and then finally returns back into this fair value gap. This is bullish 4-hour fair value gap, the bullish fair for. You see the price returns back to fill in. But today, being 30th of September, at 0 hours, an FOMC meeting, some FOMC members were speaking during the morning New York session and the afternoon. The price was held in a range. That this fair value gap was supposed to send price going higher rapidly immediately. but it didn't, or it did present some chances. If you understand how to trade in a consolidated market, you can still take your trades, but with your we must watch out for risk management, especially when prices consolidated and whipping up and down. It's looking very choppy in here. So we may get to understand what bullish fair value gap is and bearish fair value gap. This is the primary use. Once price creates a fair value gap, when it moves away, once that fair value gap becomes a key level, trader will look for price to return to this zone and then show reversal signal. Bullish candlestick in a bullish fair value, bullish candlestick pattern in a bullish FVG to enter trading direction of the original trend. I think that's explained in that chart here, that 4-hour chart. As a note, trader, some traders avoid entering within an FVG because primary main goal was deemed inefficient. They prefer to wait for price to react at the edges of the fair value gap. That's when your own strategy comes into play. At the edges of fair value gap, we tell you, okay, the price is about to continue the original trend. If it was a bullish fair value gap, and then price returns back, to, let's say this is a bullish fair value, and then price returns back here. What you'll be looking at, some traders will prefer to look at how price reacts at this edge of the bullish fair value gap. If price shows signs, the candlestick sign that the original trend is continuing, some fair value gap will whip price up and then return back, and then you find out that it created fair value gap going up and going down. So there are some traders prefer to be more sure. Yet understanding order flow is very important in fair value gap. You understand that your price is originally bullish and then creates fair value gap. So if price returns back to this fair value gap, you expect to go long from that. You expect to go long from that fair value gap, that fund. Now, for price target, we're in trend. The next fair value gap in the direction of the trend can be used as profit target. As a no trade zone, some traders avoid entering trades within the area because price movement was deemed inefficient. They prefer to wait for price to react at the edges of the gap. The life cycle of an FVG, field on field FVG, a gap that has not yet been returned to, it remains a magnet and a potential support and resistance zone. If you have fair value gap, the price has returned to and traded through once filled, its strength as support and resistance is considered diminished, yes, which is very certain. However, a field fair value gap can act as a minor support and resistance level if price reverses. Important analysis and limitations. Time frame dependent fair value gaps occur on all time frames, but their significance is greater on a higher time frame, 1 hour, 4 hour, and daily. A 15-minute fair value gap is less important than a 4-hour fair value gap. Support and horizontal horizontal support and resistance levels, trend lines over Fibonacci level, moving averages. Those are the conferences that if a fair value gap go along, then it is deemed of stronger importance compared to when it's not around it. Then it's important to understand your PDR riser. So it was at your premium, we see at the high premium, you see a fair value gap of a bearish fair value gap appearing pretty rare. Then you look for when price that turns back to that premium fair value gap. If it's in 1 hour, it's stronger, 4 hour, and daily it's stronger. The moment with this trend levels and Fibonacci level reverse, its fair value gap occur around there. Confluence of this institutional order, this institutional reference points, it's very important. Market structure bullish, heavily falling after a break of structure, very important. Not a foolproof like an AI technical to all value gaps can feel price can overshoot the gap or rip through it without reacting. This is why risk management stop loss is very essential. Now let's go into the charts and look at how fair value gaps act. There's a bullish fair value gap. You notice the high of this first candle would not overlap with the low of this candle. There's also a tiny fair value gap here in the gap. It's under the 4 hour. Now let's come down to hourly charts and see what happened around this place. I had this rectangle drawn here to show what my ADR are as premium discount area. Normally, the premium level is the 50% of this of the 50% on the high. The discount area is the 50% on the low. Then the minute point is this level below, in this level in the middle. Now look at what price it. On the 4 hour, I remember it was marked out. I marked it out on the 4 hour where the high of the where the higher of a particular. I think the 4 hour started from here, this one, and this low here. You now see that there was a inefficiency in between here on that 4 hour. On this 4 hour, let's look at it again. Now on the 4 hour, you see there is an inefficiency here. There is a bullish favor gap. Now look at what price it was. Price recovered back here and got filled, and then pulls price up again. Now look at it on the hourly. Alright, look at what price. But there's a choppy price action. I wouldn't advise someone who is not experienced in dealing with the choppy range to go into trading, especially when there is news catalyst. And on this day, the FOMC members, I think like 3 or 4 so had to speak. And FOMC is basically the committee, Federal Open Market Committee, the US Federal Open Market Committee that decides what interest rates will be, how to handle the inflation and so sorry. So FOMC members we are speaking today, the price was held in a range. It was the higher time frame algos will wait till when they finish whatever they say, then whatever they say, we have to know whether the US will still cut their interest rate lower down to 4. Because the 25 basis points was cut off, I think, is around last week or week two. They are still considering cutting down interest rate, and the interest rate is what the interest rate on USD is what moves the price. The USD already has its reputation as the world reserve currency. So you see what price did around here. We came back on the New York session. The Asian session started around here. Let me put a rectangle on that as well. Alright. The Asian session started here, but Asian session is going to start around 18 up to some other traders will backtested with up 2 o'clock. While what works best for my own back testing was up to 2:30 for my own back testing on the Asian session. The Asian session is done its own. Then here is a London session. This is Asian. And have that type of Asian session. And this is the London session. And I also opened up, took out the low of this Asian session, tapped into that 4 hour favor gap, bullish favor gap. But there was much of movement immediately. But there was significant movement. There's a 4 hour favor gap, bullish favor gap. Then later the London session took out the low of the Asians and then moved up to the open of the day. New York session went back again and back into that fair value gap and then started moving up. Let's look at other cases of where fair value gap were very smooth, and we have a fair value gap here that was not filled. Price will come back to you, and this fair value gap occurred at a discount of this range. This is the premium range, this is the discount range. This fair value gap occurred on the discount range of this momentum upwards. We look forward to seeing what price will do when it comes back here, especially if I will still have to look in because this several gap occurred on the hourly, but I will still look at it. But get today what we had was a choppy price action. There is a way to run around there to move around to scalp your way around choppy price action. Literally 2 points to take. It was already this price has come to the midpoint. Midpoint is very important in a PDR. You have a premium area, you have a discount area, and there's a midpoint. The midpoint is very important. If it reacts on that midpoint, then it's a very important place to look at your trade and find out where opportunities will be lying. The signatures that are printed out on the New York session are very important because dollar has a reputation as the world reserve currency. Now, we can look at other favorable gaps here. Look at this. This is a bearish favorable gap. You see the low of this first candle did not overlap with the high of the third candle. When you look at price reacting inside it, you see what price it and price got into this favorable gap and they are around low. You understand? So that's what I'm trying to tell you. Look at the other places where favorable gap works. We'll be looking at more examples later. This is a bearish favorable gap. Price tapped into it and then started rolling over again. You can take all these. There are breakaway favorable gap. These are not breakaway. Breakaway favorable gap are favorable gap that are not filled. Price can come back there to know and get filled. Or price can even slip it. If it happens on the support zone, on the resistance zone, price can jump over it and then take and then it starts working as a support zone. So it's important to understand our bearish and bullish favorable gap. We'll be going into more details later on the later day into more favorable gap and how the percentage works. Because some favorable gap will form and then it will start. You see, this is a price. Okay, like we have an instance that there's a breakaway gap. Notice that the high of this candle did not overlap with this candle yet. The favorable gap wasn't filled. Price came back up, but it still didn't fill up this gap. We can do then. Once you understand this, you see that not all favorable gaps actually get filled. But most important is when they occur at a very important area like this. Now it is on the premium level. You see what price did around there. The price moved from discount to premium and then from this fair value gap here. Then look at it. The price is trying to hit a strong resistance. If the price moved above, you see it tapping in and then coming back, tapping in and then coming back. The price move above this fair value gap. You see it's on resistance now, but if price moves above it, you find the price will find a support at the top of the fair value gap. It finds a support and price continues going higher. We'll still look at now examples of fair value gaps acting, but they are practically very price had a strong selling pressure. The price moves through some areas, springs through some area without tapping back. And wait for the price to return there in a later date, on a later time, for us to see whether it's going to act as resistance or support. So the basic change, these are third basics. Would go deeper into now more examples into how favorable gaps occur and how the applications are taken. But it's important to backtest your favorable gaps, but identify those favorable gaps, identify them mainly on your charts, and then look at how price has acted and on what session how price reacts with those favorable gaps. Alright, with this, we'll come to the end of this lecture. I hope to dive more into fair value gaps on a later date so that you will be more conversant with it. The more conversant you get with fair value gap, the better your trading decisions will be. That you know when the price is ever reacting to pull back from it or to flip it as a support area. Thank you. I hope you find this insightful. See you later. Thank you.